So then with that in mind, it's the most annoying question in history, but what's your 2023 market predictions? Where do you think this market's going?
Look, there's a reason why I invested in Philadelphia. One, obviously, I'm semi from the area, growing up in South Jersey, Cherry Hill, Haddonfield. It's 20 minutes away. It's kind of what what I know a little bit more. And then the second thing was it's just a more consistent market than a lot of things around the country. And for me, Philly, in theory, is supposed to prove itself in the downturns a little bit more. It doesn't have the wild swings that a couple of these other markets do. It doesn't have the massive run up, even though it has had a very large run up over the last couple of years. But it's
smaller relative,
on a relative scale, and then furthermore, when you compare it to Boston, New York, and DC along the Northeast corridor, it is so crazy affordable for what you get here in town. And it was buoyed by the remote work as well, because when DC gets crazy expensive, all right, why don't I move to Philly? I get an entire townhome for what I would get for a 800 square foot apartment in New York, and I'll just take the train back once or twice a week. So I think Philly will ride the storm a little bit better than most places. There's definitely going to be some short-term difficulties with interest rates. The big problem that everyone's running into now is, being able to cover your debt service for a construction loan that you had when you're looking to get a permanent loan or permanent debt for a multifamily or a commercial project. Is that if you have to sell or your loan expires in the next 6 to 12 months, you're in a tough spot where you have to sell, or you have to come up with a lot of money to pay off your construction loan, because your permanent loan is going to be less than what your construction loan was, which is difficult.
You're saying because to hit like a 1.25 debt coverage or something, you're going to have to lower your leverage on the perm side to maybe like 65, 70 versus what you're used to at 75 to 80.
Exactly.
So, and we're probably going to come back to this a little bit later, but just now while we're on that specific topic, I'm curious how you would personally handle that in one of your deals. Do you usually raise equity in your deals as equity and kind of syndicate it with like a GP-LP structure, or do you more raise equity as debt? And then I guess the second part to that question was, if you run into an issue where you're constrained with your loan to value on the perm side, and you're in it with 100% equity yourself, you raised all of your equity as debt, what would you do to be able to cover that piece? How would you handle that?
Yeah, so
that's a selfish question, because we have one of those coming up.
It's a very important question.
Yeah, so because we all bought these. You're working on deals you probably bought 2 years ago, and the environment 2 years ago is radically different than what it is right now. So you have to be able to adapt.
Yeah, look, I've gotten lucky in that I don't have any projects finishing in the next 6 to 12 months, probably.
And real quick to interject, are you saying that you're expecting the next 6 to 12 months to be the storm, as you said it, and then after that you're anticipating a little bit of clear skies?
Tell
me where the market's going, Brian.
That's my theory.
We want it in writing.
I tend to, troll YouTube and watch a lot of economists, and
as do we all.
Yeah. But look, I think that we're obviously in a new environment. I think that new environment will be here for a while. Personally, as bad as the United States seems like it is to people in the United States, we're relatively in a significantly better position than the rest of the world, with the U.S. dollar being the reserve currency. As there's more volatility abroad, dollars flee. Or money flees into dollars and into U.S. Investments. And so real estate in particular, when you can just print as much money as you want as the U.S. government, people tend to flee into assets that you can't mess around with as much. One of which is real estate. And, with everybody speculating about all these asset classes that, are going to go up in value or down in value, or Bitcoin and this thing. My thing always goes back to, how much income does it produce?
Yeah.
Like if you're building a townhome, you think you're going to sell it out. It's at some point, that's speculation. If you're buying a stock and you think it's going to go up, that's speculation. And at the end of the day, that's what happened, I think, in like the digital real estate world, is everybody was trying to flip these things because they thought it would keep going up. And my thought was always, well, how do you determine the value if it's not in, especially in commercial real estate, if it's not producing income? And, you know, at the end of the day, cash flow is what saves you.
You can weather any storm basically as long as your cash flow is covering your debt during the interim.
Exactly.
So.